Hello and welcome to the Financial Puzzle Playbook with your host, Jim Sumpter. I'm RJ Malik, producer of this podcast. All right, Jim, we've been talking about the 6 puzzle pieces on the podcast, past podcast. So today, what are we going to, or which puzzle are we going to be talking about today?
Yeah, RJ, great to see you, first of all. And we are going to touch on 3 pieces today. We're going to hit, as always, cash flow. We're going to dive into income tax a little bit. And we're going to talk about retirement. So if you remember on the last 2 podcasts, we talked about employee benefits and company benefits. And we started off with the insurance side of things, and then we went to the investment side of things. We talked about 401ks, 403bs. That's if you're an employee, if you're, the person that's contributing to that. Today, we're going to talk about what if you inherit one of these things. So what happens if mom, dad, grandma, grandpa pass away and you're the beneficiary? And I will tell you, this is an area where the rules have changed immensely over the course of my career. And so we're going to kind of dive into that. So one of the first things that's important when you're dealing with a retirement account, and let's talk about if this is an IRA, if it's a Roth IRA, if it's a 401k, a 403b, a Roth component of a 401k, they all work generally the same. There are some nuances, and we'll get into those, but in general, they're the same when you're talking about IRAs. Now, when you add the Roth component, there's, again, some nuances, because most things in the tax code are, there's a general rule, and then there's the exceptions. So that's what we're going to kind of jump into today. So let's say that you are a spouse and your spouse passes away and you're the named beneficiary on one of these accounts. Let's use an IRA, for example. So a traditional IRA, a rollover IRA, they're all one and the same in this purpose. You have more rules as a spousal beneficiary than you do as any other type of beneficiary. That's the first thing to understand. What are your rules? Okay, so you're a spouse, your spouse has passed away. One of the first things that you need to decide, or not decide, but understand is, was your spouse taking a required minimum distribution? What happens is you reach a certain age, and today's world is 73. That number is escalating up to 75. That number used to be 70 and a half. So I mentioned that the rules have changed. It's sort of dependent upon what the rule was when you turned that age. So in today's code in 2024, the rule is 73. So if you turn age 73 in this year, then you're starting required minimum distributions. Okay. So you're a beneficiary, your spouse has passed away. Was your spouse taking a required minimum distribution? That's the first thing that you have to understand. Your first choice is you can take and roll that IRA into an IRA in your name. Okay. If your spouse was taking a required distribution and you roll it into your name, what's going to happen is you now get to use your birth date as taking required distributions. So let me give you an example. Let's say that your spouse was age 74 and you're age 70. Okay. Your spouse was taking distributions. Now you roll over into your own IRA, but you're only age 70. You're not at required distribution age yet. You can wait until you hit required distribution age before you start taking those distributions. Okay.
Okay.
Another option that you do have is you could roll that IRA into an inherited IRA. And that means that it would be a separate IRA. So you would not be able to commingle it with your existing. You would not be able to commingle it with any other account. It would be a separate IRA. And if your spouse was taking the required distribution at age 74 and you're age 70, and you do an inherited IRA, you would continue taking that required distribution. So some of this comes down in working with your advisor. If this happens, is what sort of cash flow do you need? Because if your spouse passes away, there may be some income that you were getting as a family that you're no longer going to get. For example, you can't get 2 Social Security payments. You can only get one.
Right.
So you get the higher of the 2. It may be that your spouse was getting a pension and now you're getting none of that pension, or you're getting a portion of that pension. And so your cash flow has changed. So you have to look at, I'll go back to episode 3, which I've done many, many times. And I talk about cash flow. And I've always said cash flow, it doesn't matter if you're in your 20s or your 70s, it's still cash flow. But you have to look and say, what is my cash need? And which way is the best option for me to go? So that's your second choice. The third is if you were to inherit this as a part of a trust or as a beneficiary or a trustee of a trust, that's sort of a different set of rules. In general, what you can do if you inherit it, if a trust inherits it, you're the trustee and the beneficiary of that trust, then what you can do is take a distribution as an individual and then roll it back over into your own IRA. So those are some very specific rules. In general, most of this as a spouse, you're going to make this decision within 60 days from date of death. There are some exceptions to the 60 days. There are some reasons that might prevent you from doing it in the 60 days, and the IRS will allow for waivers and things, but those are very specific situations that you might have.
And you would have to contact the IRS.
Yeah, basically what you're going to do is when you file your tax return, you're going to put a memo, an affidavit on a certain form, and it's going to say the reasons why. So I'll give you an example as to why. Let's say that you and your spouse were both in an accident, and your spouse passes away, and you're not in a position to where you can make any financial decisions until, say, 90 days down the road. Well, you wouldn't have been able to do it within the 60 days. That would be a very valid reason that IRS would generally accept as a reason why we didn't do it. Most things with the IRS are done by either completing a form or they're done as a portion of your tax filing.
Got it.
Because see, here's what IRS doesn't know. And this is actually an interesting point. Because I've had clients ask me, well, what if I don't take this distribution? What happens? Well, IRS will probably eventually figure it out because here's what happens is the custodian, let's say that your custodian is Schwab. So your account's held at Schwab. Okay. Schwab is required every year to report that you, RJ, have an IRA in your name under your Social Security number, and they're going to report the value of your account at the end of the year. Because those required distributions, let's take a quick step back and talk about that. What a required minimum distribution is you take the December 31st value from the previous year divided by a factor that is an IRS table. Okay. When you turn age 74 or 73, and today it'll be 74 by the time you get there. It'll be 75 by the time I get there, unless they change it. So they know my birth date. They're going to know the value at the end of the year. And so there's a factor based off of my life expectancy, based off of your life expectancy. So you take the 1231 value divided by that factor, and that's your required minimum distribution for that particular year. Honestly, what it's doing is it's basing it off of life expectancy.
Sure.
So as you get older, every year that you get older, your life expectancy gets shorter. And IRS knows everything. So you need to have this thing completely distributed out. I think it's, 110, 112, something like that. It's at zero. Your factor's at 1, So there's going to be a time where your factor is 1. Okay. But that's in general what it, in general, kind of how it works. So that's that required minimum distribution. So now and there's some rules we can get into on future podcasts, but if you have money in a 401k and you're still working, you don't have to take distributions from that. If you have an IRA, it doesn't matter if you're working or not. You have to take distributions from that. If you have a 403B, it follows the 401k rules. If you have a Roth IRA, remember one of the advantages of a Roth IRA is you never have to take required distributions. So if you have a Roth IRA, and we're going to jump into this in a minute, what happens if you inherit a Roth IRA? But as far as this goes, since I brought it up, if you have a Roth IRA, the person who owns it is never going to have to take a required distribution. The spouse is going to have very similar options. They can take that Roth and treat that and put that into their own Roth, or they could do an inherited Roth, but I don't know really why you would ever do that, because you're not going to be required to take distributions from it. So that's sort of, with a spouse, you have a lot more flexibility in what your choices are. Where it really gets interesting and where it gets dicey and where the majority of the rules have changed is, what if you're a non-spouse? Okay. So here's the example. My father passed away in 2018. My mom inherited his IRA at the time. Okay. My dad was not taking required distributions when he passed away. So my mom now has this money. She had her own IRA. She could take my dad's and combine it with her own IRA. She was younger than my dad. Now the rules, it falls under her life expectancy. So when she turned at the age where she had to start taking distributions, now she has basically the combination of these two IRAs based off of her life expectancy. Every year, mom takes and distributes money from her IRA. Okay. Well, there's myself and my two sisters. So we would be considered non-spousal beneficiaries. So when something happens to my mom and we inherit that IRA, our choices are going to be more limited than what my mom's were as a spouse. Okay. So let's talk about that. It used to be, and I have a lot of clients that maybe this happened to. Let's say that my mom was not in the picture. Let's say she had already passed when my dad passed away in 2018. I would have fallen under an old set of rules, which says I, as a non-spousal beneficiary, would have been able to take that money and take out distributions over my lifetime. Now, I am older than both of my sisters. So my distribution would have been larger than my middle sister's distribution, and that distribution would have been larger than my youngest sister's distribution, because we are all three different ages. So what happens is you take that 1231 value divided by a factor, which is based off of your age. Okay. So I inherited this IRA in 2018. I'm going to be required to start taking my first distribution the year following death. So my father passed away in 2018. He actually passed away in January. My first required distribution would have been December 31st of 2019. Okay.
Oh, okay.
Because it's the year following death, and it would have been based off of my age in 2019. My sister Jennifer, it would have been based off of her age in 2019. My sister Lisa, it would have been based off of her age in 2019. Even though we all three started with the same amount of money because we each got 1/3, our required distributions were very different because our ages were different. Okay.
Okay.
That's the way those rules used to be. It's very important. If you have one of those IRAs that you inherited prior to 2020, that's the set of rules that IRA is under and will always be under, and nothing changed with those. Okay. I mentioned 2020. A lot of things happened in 2020 because, quite honestly, the CARES Act was signed in, and this was part of the CARES Act. But we really just now, over the last couple of months in 2024, got clarification on something. Okay, so here's what I want to go into. In today's world, if you inherited an IRA as a non-spousal beneficiary and you are not a minor, I want to throw that caveat in there because if you're a minor, there's another set of rules, another set of exceptions. Keep in mind, Congress writes tax code, okay?
Yeah.
And we'll just leave it at that. Congress writes tax code. I don't know why it's so complicated, but it is. And so let's step back. I'm after 2020. Let's say my mom now passes away in 2024. My three sisters and I inherit 1/3 each of her IRA. I'm a non-spousal beneficiary. Here's the new set of rules. It's a 10-year rule. What that says is I have to have the value of that account to zero within 10 years.
Oh.
Okay.
Yeah.
So here's what that means. I'm going to use an example. Let's say my mom's IRA is $300,000. Okay. And I inherit $100,000. My sister Jennifer inherits at $100,000. My sister Lisa inherits $100,000. Okay. We all three are equal at that start. But here's where it comes in. And this is why it's important to know, did the deceased, the decedent, were they taking required minimum distributions? My mom is. So here's what we would be required to do. If she passes away in 2024, God forbid it happens, I hope it doesn't. But if she passed away in 2024, by December 31st of 2025, we have to take a required distribution because my mom was taking a required distribution. That is the clarification that came into play. Okay, so that is now the rule. Because none of us are minors. So we're adults of age. We inherited as a non-spousal beneficiary. Okay. My distribution is going to be based off of my life expectancy. My sister Jennifer's is based off of her life expectancy. My sister Lisa's is based off of her life expectancy. So the required minimum distributions are all three different. But the one constant is all three have to be at zero by December 31st of 2035, which is 10 years from now. Okay.
I have a question.
Go ahead. Yeah, sure.
Since it's required to have it happen in 10 years, is it possible to just take the whole thing and move it into another account?
Let me answer your question in two parts.
Okay.
Is it possible to take the whole account? Yes. Can you move it into another account? No. This account always has to stay an inherited IRA. And then honestly, what it would do is it would show the decedent's name. And so it would be the inherited IRA under the decedent of mom. My dad's, in my previous example, would be the inherited IRA under the decedent of dad's name. Okay. So, and again, if that's my situation, which this is a lot of times what happens is you will inherit retirement money from both parents at separate times. They are always treated as two separate accounts. And the rules could be different depending on, were they taking a required distribution? What was their age that they passed away? what year did they pass away, and what was the law at that particular time.
Wow.
Okay. Yeah. So again, my dad's that passed away in 2018, that one stays always and forever. This new 10-year rule does not apply to that IRA. What does apply is now my mom's. Okay. So let me take one other quick step back and answer your question. Could I take the money out? And the answer is yes. You can absolutely take it out faster than 10 years, but it has to be at zero within 10 years. Okay. But here's the thing. When you take money out, that's ordinary income, so it's taxable income. Okay. So if I'm working and I inherit this, but let's say I'm going to retire in 5 years. I'm not, but let's say that I were. What I would probably want to do while I'm still working and while I still have earned income and my income is larger than it probably will be in retirement, I would want to take this out as slow as I could. And then in year 6, I might want to take more. I'm in 6, 7, 8, 9, 10. Then I would maybe start my distribution. But that 10 years starts from the year following death. Okay. Okay. All right. So that's the new 10-year rule. We talked about we can't combine. We talked about 2020. Those rules are different. Let's go back and talk about a Roth IRA. What if my mom has a Roth IRA? Okay. Well, Roth IRAs don't have to be distributed. I mean, I don't have to take required minimum distributions from Roth IRAs, so neither did mom, but I have to take it out within 5 years. Again, Congress wrote the rules. There's all these different rules. Okay. That's if it's an IRA or a Roth IRA. What if it's a 401k? Okay. So you mentioned on the last podcast that you had a 401k at your current employer. Correct. Okay. Mm-hmm. And you have children, I believe. Am I correct on that?
No, we don't have children.
You don't have children. Okay. No. Okay. Well, I will give you all of my information. Okay. And so if you need a new beneficiary, just let me know. Okay. Okay. Let's say you had children.
Yeah.
Okay?
Yeah.
Let's say you had children. Okay. Let's say, and I know you're married. And so let's say something happens to RJ. Okay. Your wife is your beneficiary. Right. Now your money goes to her. She absolutely cannot survive and live without you. She has been with you all of these years. Okay. You're now gone. She says there is absolutely no way I can continue. And she passes away 10 days later. Okay. Okay. Now your children are the beneficiaries. Okay. So now they're non-spousal beneficiaries. But here's what happens. Your wife, because it was within 10 days, she just absolutely, was so distraught. She couldn't get everything done. The money's still in a 401k. It never made it to the IRA, but she's your beneficiary and your children are your contingent beneficiaries. Okay. Well, she's not around to accept the funds. So now it's sitting in a 401k. What you do is it's basically the same rules. You take that 401k, you roll it over to an inherited IRA under RJ for X number of dollars. You're not taking required minimum distributions. They would then have 10 years to get that account to zero. Okay. Okay. Yeah. 3 years from now, your son, who doesn't exist, but his wife, who also doesn't exist, decides that she wants to remodel the bathroom. And so she talks your son into taking out a $30,000 distribution. They're perfectly fine to do that, but that distribution is going to be taxable income. Okay. Got it. All right. Let's also talk about your son that doesn't exist. So you live in New Jersey. Your son that doesn't exist, let's say he lives in Ohio. Okay. Right. Mm-hmm. And so if money goes to your wife, then your wife, when she takes out distributions, is going to pay federal tax and she's going to pay tax in New Jersey because that's the state that she lives in. Okay. When your son, who doesn't exist, inherits this money and he lives in Ohio, when he takes a distribution, he's paying federal tax and he's paying Ohio income tax because that's where He
Okay.
took the distribution at the time.
That makes sense.
Okay.
Yeah.
So we've talked, we've talked about kind of how does state taxes work in this a little bit. I will throw one caveat. So, and this is so Pennsylvania, okay, has what's called an inheritance tax. Okay.
Okay.
I have a client that lives in Pennsylvania. He has no children and he has no spouse. Okay. So he has named his 4 nieces and nephew as beneficiary of his IRA. Okay. So if he passes away, and by the way, I take that back. One of the beneficiaries lives in Pennsylvania. One lives in, I think, New York, one in Vermont, and one in California. Okay. So we got 4 beneficiaries all over the place, but he lives in Pennsylvania. Pennsylvania has an inheritance tax. So if they inherit this IRA, they are going to roll it into an inherited IRA, but they're going to owe Pennsylvania inheritance tax because that's where he lived when he passed away.
Okay.
So all of here's my whole point in this. There is a plethora of rules that you have to look at, so many different parts to this puzzle just to inherit one of these things. But there is more money in retirement accounts in general than there is in non-retirement accounts.
Okay.
And so this is a very common thing that we run into all the time. I did mention a couple of times if someone's a minor and they inherit an account, because, a minor can own an account. A minor can own an inherited IRA. So let's say that, I'm 35 and I have 2 kids that are 8 and 6, and I pass away and my wife passes away. So my IRA or my 401k or whatever retirement account goes to my kids. Well, somebody's got to be the custodian for that, and that's okay. Hopefully my will, we talked about in a previous episode about the importance of having a will,
right?
That someone has to be the financial manager of the money for those minor children. So hopefully we've done that. But now they're going to have these 2 accounts. Well, one's 8 and one is 6. Well, they can't make financial decisions because they're minors. And so do they have to take a required minimum distribution? And the answer is no. Okay, they do not. But the money, once they become an adult, once they hit age of majority in whatever state they're in, and those are different.
Okay.
So it's whatever age of majority is in the state that they're domiciled in.
Okay.
Mm-hmm. Now their window starts, and now they've got to start taking money out.
All right.
Okay. But up until then, if you're a minor, you don't have to. Okay. One more caveat that I'll throw out there. If I'm a spouse and my spouse was 10 years younger than me, different set of rules.
Really?
Yes. Different set of rules.
Okay.
So I am not suggesting that I would ever do this, and I can't believe I'm actually saying this on a podcast that my wife will probably listen to. Okay. But I'm 54. Okay. And this, honest to God, this happens. Okay. So let's say something happened to Jennifer. Okay. And then I married someone that was more than 10 years younger than me, and they became my beneficiary.
Sure.
Okay. So now they inherit money that's in a retirement account. They're 10 years younger, different set of rules. It kind of goes back to, it's kind of a mid, but it kind of goes back to the 10-year rule with non-spouse. But there's some, so again, there is this whole plethora of what happens if.
Right.
And so it's, I guess my whole point in this whole thing, it's not as cut and dry as you would think.
No.
Because you would think just because you're a beneficiary,
right,
that it's all the same rule. It's not. There's all these questions that you have to ask. So that's why I thought, well, this would be an interesting podcast, and we title it, You Inherit an IRA, Now What? because there's all these different sets of rules. Like most things in tax law, it's clear as mud, right?
Yes. Perfect way to put it. Clear as mud.
Absolutely.
I like that.
So RJ, what questions are there? Any?
No, I just will just emphasize the fact that, I did not know all these different rules for different ages and different and things like that. And I guess my comment would be, it's really important to have, and I know this is going to sound like I'm shilling for you, but it's important to have a financial advisor, because, I work a different job and my wife works a different job. So we're not focused, managing your finances is a full-time job.
Yeah. Yeah. It's an interesting point, because we talk about things like that all the time about, if things were as cut and dry as they appear, sometimes, sure, it would be easy, but I'm talking about if my dad passed away just 6 years ago.
Right.
And if my mom passed away today, that's two separate accounts with two separate sets of rules. And the only thing that has changed is the time frame. That's the only thing that's changed. And so you have to know what's going on. And, I talk about the financial puzzle all the time. These are puzzle pieces.
Exactly.
Yeah. Because keep in mind, I talked about three puzzle pieces. I said we're going to talk about retirement because you could use this as part of a retirement account. It is a retirement account that you are inheriting. So that's the first thing. We've talked about the plethora of the income tax code and how all the different sets of rules. And then it kind of comes down to, what is your need for cash flow? Do you need cash flow to supplement something? So if I'm a spouse and I've lost if I've lost my wife and I've lost part of our family income,
right,
then how do I replace that? This is a way to replace it. So now I'm under that spousal set of rules. If I'm a non-spouse, then I'm under a different set,
Yes. Yeah.
and then if I'm more than 10 years in age different, there's a third set. And if there's a trust involved, there's a fourth set. So here's my point is, that's what an advisor will do is sit down. And this is why the tax planning part of what we do at CMC is so important, I think, because every single person's situation is different. And that's what I kind of wanted to cover in this very simple topic of, you inherited an IRA, now what? So
simple.
RJ, that's all I've got. I don't know if I can throw any more rules out there.
Yeah, and you hit it right on the head when you said it's clear as mud. It's clear as mud.
Yeah, absolutely.
Okay.
Absolutely.
All right. How can people contact you, Jim?
Yeah. So there's a like the tax code, there's a plethora of ways. Okay. So my direct phone number is 205-510-9074. You could call or text me there. Our website is cmcfp.com. On there, we have an info tab. You can also reach any of our partners that way. We're also on all the social medias, Facebook, LinkedIn, Instagram, and YouTube.
All right. Sounds good. And most importantly, thank you for listening to the Financial Puzzle Playbook podcast. We ask you to share this podcast, rate it, and leave a review, because this actually helps others find the show. Again, thank you for listening. And for everyone at the Financial Puzzle Playbook, I'm RJ Malik, and we'll see you at the next podcast.
Thank you for listening to the Financial Puzzle Playbook. Click the follow button to be notified when new episodes become available. Don't forget to follow us on social media by checking the links in the description. And contact us today by visiting our website at www.cmcfp.com or give us a call at 205-510-9074. Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security, or engage in any specific trading strategy. Results will vary. Past performance is no indication of future results or success. Market conditions change continuously. This commentary reflects the personal opinions, viewpoints, and analyses of CMC Financial. It does not necessarily represent those of RFG Advisory, Private Client Services, their clients, or their employees. This commentary should not be regarded as a description of advisory services provided by CMC Financial or RFG Advisory, or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Securities offered by registered representatives of Private Client Services, member FINRA SIPC. Advisory services offered by investment advisory representatives of RFG Advisory, a registered investment advisor. Private Client Services, CMC Financial, and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place.